Well, hello everyone. Today we have a sponsored video topic. Now, of course, if you want to sponsor a video on the channel, the instructions are linked here on screen. There will be a video pinned in the comments that explains exactly what to do. And if you are looking to sponsor a video, keep an eye out. For now, I only accept payments through PayPal, but later, I'm considering and working on adding a Ko-Fi link to make your payment and processing of the sponsored video much smoother and much easier. Let's get started with the video. Okay, today I was sponsored to give my thoughts and views and feelings about, of all the companies, Gladstone Land. You know, you almost don't have to pay me to do this. I've talked about this stock so many times on the channel over the years, it's no work at all, but thank you very much, you know who you are, for sponsoring this video. So let's get started. Gladstone Land. For those of you who aren't acquainted with this stock, it is a farmland REIT, and a REIT is a real estate investment trust. So what this company does is it gets money, it raises money through debt and other means, and buys farmland, that's real estate, and on that farmland, they bundle it all together, and then because they're a REIT, they're obligated by law to distribute 90% of their earnings as dividends. And you can see right here, land is about a $9.60 stock, its dividend yield is 5.75%. And checking in on those dividends, they are paid monthly, every month, not quarterly, not yearly. They are paid monthly. And these dividends, of course, are common, not qualified, which we'll get to later. The market cap is $350 million, so by no means is this a small company. First thing when I take a look at a stock is I always want to see the past. I want to see, has this company over its lifespan delivered returns to investors or delivered losses to investors? And we can see here, not factoring in dividends, which is important, we'll get to that in a moment, but share price alone, this stock has returned negative 36% across its entire life. And you can see now, actually, its current price is lower than the price it IPO'd at, which seems to be about $14, $15, $16 that the company initially IPO'd at. But of course, that's not the whole story. You have to factor in dividends. So on average, since inception, the company has returned 10.43% or about 0.81% a year, which is not great. And so you see, if you started with $10,000 in 2013, you'd only really have $11,000 today. Now, that's obviously not the reason why you'd buy a stock like this, but these results are not encouraging. Now, of course, very few of you were investing in 2013, but it's good to take a broad level view of a stock like this. Next up, let's compare the benchmark. I like to compare land versus an index. And in this case, I'm comparing land to VT, which is an index for the total world stock market, both US domestic and international. And so you can see the end value, if you started with $10,000 in 2013, with VT, that would be worth $31,000 today. And with land, it would only be worth $11,000, with VT returning 200%, or on average, almost 10% a year. So versus the benchmark, looking back, it hasn't beaten the benchmark when you're comparing a stock. Now let's compare the returns by year. Obviously the returns are not the same every single year, so it does vary. You can see that during the Corona years, 2000, 2021, and 2022, when I was talking about this stock, it delivered outsized returns, but most other years it did not. I believe I owned this stock from about 2020 through 2023 or 22. It's linked on my channel when I sold that stock, and so that was a good time to buy it, but I got into the stock for a very specific reason, which we'll get into later. Now let's look at the revenue growth. That's a very top-line thing you do need to take a look at. And the revenue situation for land is discouraging. Frankly, it has been decreasing dramatically since 2020, which in all fairness was a peak year, but still, you should not be seeing dramatic declines in revenue growth year after year for 5 years straight. Generally, investors like to buy companies that are growing revenues, not shrinking them. Check out the operating margin too. For those of you who don't know, the operating margin is a test if the basic operations of the business work or are profitable or not. A positive operating margin is good. A negative operating margin is horrible. It means their basic business does not work. And so every time a customer engages with their business, if you have a negative operating margin, that means you're effectively giving the customer money because your basic services and goods are not profitable. And so while land does have a very strong operating margin at 34%, it has been dropping for the last 5 years, which is also a bad sign. That means their basic business model is becoming less and less profitable as time goes on. Next up, current ratio. This is something that is a good sign. their current ratio is rising, meaning that they have the current assets or easily convertible assets like cash and near cash items to cover their short-term debt. So this is a good indication that their debt situation is getting better. So that's one piece of positive news for this company. Long-term debt is also dropping. It seems like they did take on some debt during their good years to make some purchases and make the best of the situation, and ever since then they've been paying down their long-term debt. That's another positive sign. Now, I wanted to compare Gladstone Land to another farmland company in the same sector. This is Farmland Partners. This is another farmland REIT. Not as bad, negative 21%, and their revenue growth since 2022 has been more or less stable, not dropping as precipitously as Gladstone Land. So on these two metrics, actually, Gladstone Land is worse than one of its comparable competitors on the benchmark for farmland REITs. Now, this is the real key. Any serious analyst who follows the stock, they like to keep track of, and I understand why, they like to keep track of the number of farms that the company controls. Because the farmland business moves at an elephant's pace. It moves extremely slowly. These farmers are old, they're stubborn, they're stuck in their ways. They don't want to sell for the wrong price. They want to hold on because farm prices go up and up and up. It is hard to find farmers that are willing to sell because many of these farms have been in their hands for generations, and they're not eager to part with it. So comparing 2024 last year to up now in 2025, you see that the number of farms they controlled has fallen by 19. And you're going to see this here in a second. Look at the number of farms that Gladstone Land has controlled each year. It peaked in 2024 and 2023 with 169 farms and has dropped since last year. In fact, the number of farms we haven't seen in this company since 2021. So it took all the way from about 2021 to 2023 or 2024 to buy the number of farms they lost in a single year. And you can see generally across the entire trend of the company, growing from 73 farms in 2018 to just 137 in 2021, it's very slow and difficult to grow this company by taking over and acquiring farms. So when you see the company ditching farms or cutting down on the number of farms they have, that's a very bad sign. Especially when it's the first loss that I've seen posted on record of their farms ever since I started tracking in 2017. A lot of people do like this stock because you can see it did amazingly well between 2020 and 2022. The stock price went up dramatically. We're talking hundreds and hundreds of percent. It looks like it went from about $9.59 to over $40. Now, many of you may be wondering what happened and will it happen again? Well, it's obvious what happened. Basically what happened was, during those years, starting in 2021, there was a high wave of inflation. In the US officially, it was about 7% in 2021, 6.5% in 2022, and 3.4% in 2023. So inflation was high. People wanted to get into a safe harbor asset, and farmland is a good example of that. When you buy something like farmland, you are getting inflation protection, but on the flip side, you're not getting upside gains. It grows much more slowly, and it is outpaced by other assets. And you can see it totally correlates with the inflation rate in the United States. There are many stocks that are not positively affected by inflation, but this was one of them. So at the time, if you believe that inflation was going to peak and spike, like I was talking about on my channel, it seemed like a good time to buy. And the results now looking back in 2025 prove that point. Another reason why Gladstone Land did so well in 2021, 2022, and 2023 is, I hate to say it, the Ukraine war. Between Ukraine and Russia, they produce nearly a fifth of the world's wheat supplies, not to mention sunflower oil and barley. And on sensitive commodities like this, a shock to the food supply can send prices soaring, and they did, because people were worried about Ukraine's farmland. Would they be captured? Would they be destroyed by the conflict? And then Russia's production of food. Also, people were worried that they would be sanctioned and no longer accessible to global markets. And that was another thing that grew the stock price of American domestic food producers like Gladstone Land. So this was another reason why I talked about this stock on my channel, because I knew that Ukraine and Russia were major food producers, and the conflict would put a strain and endanger that supply of food. Agreements have been made between each country to ship food through the Black Sea, and now the food problem isn't nearly as bad as it used to be, and so as a result, the stock price and price action of the stock has returned to where it was before the war even started. Let's talk about farming generally. One way to tell how well an industry does is to look at the influencers in that industry. And an influencer usually puts the best face forward, so you do have to be a little bit skeptical when you see someone trying to portray a lifestyle. It's usually not totally real. But in this case, for farming, we don't have to worry about that. Why? One of the larger farming influencers, one I watch, he admits and shows openly, He's very transparent with his finances that he loses money farming. And how he makes up the difference for the losses in farming is he is a farming influencer. He creates content about it. His YouTube money plugs in the gap. And also he's developing an iOS game about farming with his brother. So you can see when even the influencers can't portray the life as a major cash cow or cash influencer, it's a little bit difficult to make money in this industry. And so you can see why Gladstone Land have struggled. Let's rewind the clock again, once again, to those peak years of Gladstone Land. Think back. Inflation was very high. We talked about that. There was a shock to the food supply. We talked about that and why, the war. But also, one really important thing was tech was boring back then, and it felt dead. The most exciting thing to come out of the tech world that time was the metaverse, which we know now was a total flop. This was before the AI tech boom we're seeing today. And now because there is excitement and there are returns being delivered by the tech industry, farming is just less appealing now to investors than it was years ago when everybody was scared by conflicts and pandemics and rising inflation. Investors were interested in safety, so if you were selling Gladstone Land and other companies like that back then, you could sell those for a high price. But now, it's hard to sell those investments to investors because there are exciting options available for you now if you want to make money from AI and other hype stocks. So that's another reason why money has continuously cycled out of safe harbor assets like farmland since 2023. Now, a lot of people don't care about all of this because many people who are in stocks like Gladstone Land or would pay attention to it are dividend investors. So let's talk about the dividend. First of all, this is an ordinary dividend. Gladstone Land pays an ordinary dividend. What does that mean? There are two types of dividends, ordinary and qualified. Qualified dividends are taxed at a special tax rate that is lower. I believe it's 15%. It could be 20%. But anyway, it's a static tax rate. And it's almost always lower than the ordinary dividend. An ordinary dividend is taxed at your tax rate. Meaning that if you're in a high tax bracket, or really any tax bracket, because the qualified dividend rate is quite low, ordinary dividends are taxed, generally on average, almost always, at a higher tax rate, making these dividends less efficient. And so going back to the total returns, this is factoring in dividends. So when you factor in the stock losses and the dividends together, this stock only returns about a positive 8.4% every year. And that's not including taxes you have to pay on these dividends, which dividends are often tax inefficient. And so doing some financial analysis, I had to boot up Excel for this one. At $9.74, the current price of land on the stock market, generally that's a signal from the market that the market expects land's revenue to keep falling at about 5% a year, for their free cash flow margins and price to earnings ratios to remain stable, and for the share buybacks to remain stable at about 0.53% every year. And so, running some numbers, I used actually the Strongman Personal Finance discounted cash flow stock analysis tool. I would say this stock is worth about, fairly right now, $9.22 a share. But if you wanted to purchase the stock with a decent discount rate, meaning an expected rate of return, comparable to VT, a fair share price that I would buy to just match that, ignoring the concentration risk, would be about $7. So even at $9.22, which is not the current stock price, you're paying for a very low return with concentration risk. And so the question to any investor would be, is that worth it? Now, with that said, if you do expect their revenue growth to rebound, and this is getting to the land of hypothetical, that is not now. The price I talked about before is just a snapshot now what the market values it at. If you expect Gladstone Land's revenue to recover, I would say any price below $12 is a good value. And that's because $12 has historically been Land's resting price, more or less in that range. And considering that they haven't massively share diluted, the share count is more or less about the same. Anything below $12, if you expect a turnaround at this company, is a good price. Now that said, that is a very big mountain to climb. Revenues have fallen, so in order to grow them back, you would need massive increases, percentage-wise, on their revenue, and they're doing that, as you saw before, on fewer farms than they had before. And as I told you, the farmland world moves at a glacial pace. It took years to buy up that many farms. And so it would take a massive buying spree and spending spree to buy those farms, which I'm not sure that can happen. So as an alternative, if you like the return, if you like the dividends and concept of owning farmland, there are alternatives for you. This company offers 3 different preferred stocks. So you can buy this company's debt and get money from their farmland operations, but as a debt holder, as a bond holder, so to speak, not literally. In this case, it's a preferred stockholder. As a preferred stockholder, you can get access to the same business model, but with different financials. So one I wanted to focus out of the 3 they have is Land P. You can find all 3 in their SEC filings. Land P One share is about $19.80. The dividend yield on this is 7.58%, so that is a higher percentage for those of you who care about the yield. And also, guess what? The payment schedule is monthly. Now, it's still common, but you're still getting monthly dividends with their stock. And now let's look at the total return. The total return, if you invested in the debt, the preferred stock is a type of debt, $10,000 2 years ago would be $11,000 today. And so those are positive returns. And then on top of that, if you can find somewhere to borrow money at less than 7%, you could potentially arbitrage on the stock. Now, I think that's almost impossible, but you could. So in my view, the debt on this is much more interesting than the actual stock itself. Borrowing, again, some macro events that cause inflation to rise and investors to prefer safer assets like farmland. Now, I don't own land. I don't plan to buy land or its debt. I wouldn't buy its debt because that's too much of a concentration risk. I own VT. That's the only thing I own. But still, looking all this over, the debt is more interesting. Okay, that's all for this video. Thank you so much once again for sponsoring this topic. You know who you are. If you want to sponsor a video, link is down pinned in the description. Follow me on Telegram for day-to-day updates. I have some new exciting videos coming through in just a few months. Great topics. I'm planning them now as we speak. It's been a while. I missed you. I will see you in the next video. But before you go, watch this video now on screen. YouTube thinks you'll like it. Bye.